Getting from 100,000 to 1 million isn't about luck. It's not about timing the market. It's not about finding the next Tesla or riding some crypto wave. That's what losers tell themselves when they blow up their accounts chasing rainbows. The real secret? It's so obvious that 95% of people miss it completely because they're too busy looking for magic tricks. I've watched thousands of people hit 6 figures and then promptly destroy themselves. They get to 100,000 and suddenly think they're Warren Buffett's smarter cousin. They start trading options, chasing momentum stocks, listening to some 24-year-old on YouTube who made money in a bull market and thinks he's discovered fire. Then the market turns and that 100,000 becomes 60,000, then 40,000, and they spend the next decade trying to climb back to where they started. It's pathetic, but it's predictable. Here's what nobody wants to hear. The jump from 100,000 to 1 million is mostly about not being stupid. That's it. That's the secret. Don't be stupid with your money. But humans can't help themselves. They confuse activity with progress. They think because they're watching Bloomberg and reading earnings reports that they're doing something productive. They're not. They're just getting anxious and making impulsive decisions that erode their capital. When I was younger, around 38 or so, I watched a lawyer named David throw away 130,000 in 18 months. Smart guy, top of his class, argued cases beautifully, but put him in front of a brokerage account, and he turned into a gambling addict. He'd buy a stock Monday, sell it Wednesday, buy something else Thursday. Paid more in commissions and taxes than most people make in a year. The market went up 20% during that period. David went down 40%. That's not bad luck. That's self-sabotage dressed up as sophistication. The path from 100,000 to 1 million is simple math if you don't screw it up. At 10% annual returns, you're looking at roughly 24 years. Most people hear that and their eyes glaze over. 24 years? That's forever. I want it now. I deserve it now. I worked hard for this money. And that impatience is exactly what keeps them poor. They can't stomach the boredom of compounding, so they reach for yield, leverage, speculation, anything that promises faster results. And faster results always come with bigger risks they don't understand until it's too late. But here's the thing about that 24-year timeline. It assumes you just sit there like a statue doing nothing but collecting returns. It assumes you don't add another dollar. It assumes you don't increase your savings rate, don't get raises, don't build side income. For most people who are actually disciplined, the real timeline is closer to 12 to 16 years because they're feeding the machine while it runs. But even that sounds like eternity to the instant gratification generation, so they blow themselves up trying to compress time. I learned this watching my father. He wasn't rich, worked as a federal judge, lived modestly, saved consistently, died with more money than men who made triple his salary because he understood one thing they didn't. Wealth isn't built in explosions. It's built in increments so small they feel meaningless until you look back over years and realize the mountain you climbed. He'd buy quality stocks and hold them until they split, then split again, then paid dividends that bought more shares. He never made a brilliant trade in his life, never needed to. The people who successfully make the jump from 100,000 to 1 million share one trait: patience that borders on stubbornness. They're not smarter than everyone else. They're not working harder. They're just refusing to participate in the circus. While everyone around them is jumping from trend to trend, they're sitting still, collecting dividends, reinvesting distributions, letting time do the heavy lifting. It looks boring from the outside. From the inside, it's the most exciting thing in the world, because you're watching real wealth accumulate instead of chasing phantom gains. You want to know why most people never make it? Because they can't differentiate between investing and gambling. They think buying stocks is investing. It's not. Buying stocks is just buying stocks. Investing is buying productive assets at reasonable prices and holding them long enough for the business to create value. Everything else is noise. The daily price movements, the talking heads on TV, the fear and greed cycles. It's all noise designed to separate you from your capital. And most people can't tune it out. They need the excitement. They need to feel like they're doing something. So they trade and they lose. Here's a fact that should terrify you. The average investor underperforms the S&P 500 by about 3% to 4% per year. Not because they pick bad stocks, though they do, but because they can't sit still. They buy high when everyone's optimistic and sell low when everyone's panicking. They pay taxes on gains that shouldn't have been realized. They rack up fees on transactions that shouldn't have happened. Death by 1,000 cuts, except each cut is self-inflicted. And over 24 years, that 3% to 4% difference is the difference between 100,000 becoming a million or 100,000 becoming 400,000. The real secret Charlie Munger figured out decades ago is this: getting rich is about avoiding stupidity more than seeking brilliance. He'd say it plainly: invert the problem. Don't ask how to get rich. Ask how people stay poor, then don't do those things. Sounds simple, right? But simple doesn't mean easy, because human psychology fights you every step of the way. I knew a woman named Patricia, 52 years old, nurse practitioner, finally saved 1 to 15,000 after years of grinding through night shifts and double overtime. She was so close. All she had to do was not screw it up. Then her neighbor bought a Tesla. Her coworker started bragging about some penny stock that tripled. Her brother-in-law kept talking about real estate deals, and Patricia couldn't stand feeling left behind. Within 2 years, she'd blown 35,000 on 3 different get-rich-quick schemes that went nowhere. She's 61 now, still working, still bitter, still blaming the system instead of her own impatience. The market doesn't care about your feelings. It doesn't care that you're tired of waiting. It doesn't care that you deserve faster results. The math is the math. If you have 100,000 and you can generate 10% annually, you'll cross a million in about 24 years. If you add just $300 a month to that, you cut it down to 18 years. Add $600 a month, you're looking at 15 years. These aren't exciting numbers. They don't make your heart race, but they're real, and real beats fantasy every single time. But here's where people destroy themselves. They see those timelines and think, there's got to be a faster way. And technically there is. You could double your money every year and turn 100,000 into a million in under 4 years. Problem is, the strategies that promise those returns also carry the risk of losing everything. And most people can't tell the difference between aggressive and reckless until they're staring at a zeroed-out account, wondering what happened. I watched this play out in 2021. Everyone became a genius in a market that only went up. People who couldn't spell diversification were giving investment advice. They'd throw 100,000 into some meme stock or speculative tech company, watch it run up to 180,000, and suddenly they're texting their friends about retiring early. Except they didn't sell. They held because the Reddit forum said diamond hands. And when reality came back in 2022, that 180,000 became 90,000, then 60,000, and they spent all of 2023 in denial, holding bags of garbage waiting for a comeback that's never coming. The difference between 100,000 and a million isn't about making brilliant moves. It's about not making catastrophic ones. Every dollar you lose requires an even bigger gain to get back to even. Lose 25% and you need a 33% gain just to break even. Lose 50% and you need to double what's left. The math gets cruel fast. That's why preservation beats aggression every time. Munger understood something most investors never grasp. Your returns don't need to be spectacular. They just need to be consistent and compounding. He and Buffett didn't average 50% returns. They averaged around 20% over 6 decades. 20% doesn't sound sexy until you realize what it does over time. It's the difference between building generational wealth and staying on the hamster wheel forever. I've seen people with 100,000 chase 30% returns and end up with 60,000. I've seen people with 100,000 settle for 9% and end up with 1.2 million 15 years later. The tortoise beats the rabbit not because he's faster, but because he doesn't stop to chase distractions. Boring wins. Consistent wins. Patient wins. But nobody wants to hear that, because boring doesn't get clicks, doesn't get likes, doesn't make you feel like a genius at cocktail parties. Here's the trap. You'll see people getting rich fast, or at least appearing to. Crypto millionaires, day traders with Lamborghinis, real estate flippers posting from beaches. What you don't see is the 100 others who tried the same thing and lost everything. Survivorship bias is the most expensive lesson in investing. You see the winner and think that's the strategy, but the strategy that created one winner also created 99 losers. You're just not seeing their stories because they're not posting from beaches. They're posting from their parents' basement, wondering where it all went wrong. The path from 100,000 to a million requires one thing above all else: the ability to say no. No to hot tips. No to get-rich-quick schemes. No to complex strategies you don't fully understand. No to leverage you can't afford to lose. No to excitement disguised as opportunity. Every time you say no to stupidity, you're saying yes to compounding. And compounding is the only force powerful enough to turn ordinary people into millionaires without requiring lottery ticket luck. If you're still with me, if you're realizing that patience beats panic and discipline beats speculation, hit that subscribe button. I need to know there are still people out there who want the truth instead of fairy tales. And drop a comment telling me the dumbest financial decision you almost made or actually made. Let's learn from each other's mistakes, because God knows we've all made enough of them. The thing about turning 100,000 into a million is that it happens in stages you can't see until you're past them. There's a point, usually around 250,000, where something shifts psychologically. Your investment returns start producing numbers that feel meaningful. A 10% gain isn't 10,000 anymore, it's 25,000. That's a car. That's a year of rent somewhere. That's real money, not rounding error money. And that's when you either level up or blow up, because real money makes people do stupid things. I knew a guy named Robert, 44 years old, software engineer, got his portfolio to 280,000 through pure discipline, lived below his means, maxed out his retirement accounts, didn't touch the money for 8 years. Then one quarter his portfolio gained 32,000, and something broke in his brain. He started thinking he was good at this, started researching individual stocks, reading analyst reports, convincing himself he could pick winners. Within a year, he'd traded himself down to 235,000, lost 45,000 trying to be clever, when all he needed to do was nothing. Last I heard, he's back to index funds, but those years of compounding are gone forever. You can't get time back. This is where Munger's philosophy becomes critical. He always said the big money isn't in the buying and selling, it's in the waiting. Most people can't wait. They need action. They need to feel smart. They need to tell stories at dinner parties about their investing prowess. So they trade when they should hold. They pivot when they should stay still. They optimize when they should leave well enough alone. And every move costs them, in fees, in taxes, in opportunity cost, in compounding interrupted. The math on this is vicious. Let's say you have 100,000 growing at 10% annually, and you just leave it alone. In year 10, you've got 259,000. In year 20, you've got 673,000. In year 24, you've crossed a million. But if you interrupt that compounding even 3 times by selling everything and sitting in cash for just 6 months each time because you got scared or greedy, you can stretch that timeline to 30 years. 3 moves, 6 months each cost you 6 years. That's the price of thinking you're smarter than the market. Here's what people don't understand about wealth building at this level. From 100,000 to a million, you're not trying to hit home runs. You're trying to avoid striking out. Singles and doubles win this game. Consistent returns compounding over time beat spectacular gains interrupted by catastrophic losses every single time. But our culture worships the home run hitters. We make movies about the people who got rich fast. Nobody makes a movie about the guy who bought an index fund in 1995 and checked it once a year until he retired rich in 2020. That story is boring. It's also the story that actually works. I watched this play out with a couple, James and Linda, both 49 years old when they finally got serious about investing. They had 135,000 between 2 retirement accounts and a taxable brokerage. James wanted to be aggressive, chase growth stocks, swing for the fences. Linda wanted boring index funds. They compromised, put 70% in indexes and gave James 30% to play with. Over 13 years, Linda's boring 70% grew to 680,000. James's exciting 30% grew to 90,000. He picked some winners, sure, but also picked enough losers that he barely kept pace with inflation. His 40,000 gamble turned into 90,000, while Linda's 95,000 patience turned into 680,000. Boring, crushed, exciting, and it wasn't even close. The secret isn't complicated. Buy quality assets, reinvest the distributions, don't interrupt compounding, add money when you can, and leave it alone for decades. That's it. That's the whole strategy. Everything else is distraction designed to make you feel productive, while actually costing you money. The financial industry doesn't make money when you sit still. They make money when you move. So they give you research, tools, alerts, newsletters, anything to keep you active. Active investors are profitable customers. Patient investors are not. Here's the cruel irony. The more you care about your investments on a daily basis, the worse you'll perform. The people who check their balances daily make worse decisions than people who check quarterly. The people who read every market headline panic more than people who tune out the noise. Information overload doesn't lead to better decisions. It leads to paralysis or impulsiveness, both of which destroy returns. The optimal amount of attention to pay your portfolio once it's properly allocated is almost none. Set it, forget it, live your life. But nobody can do that because humans are wired to fidget. Munger lived this philosophy. He and Buffett would buy companies and hold them for 30, 40 years. They didn't care about quarterly earnings beats or misses. They didn't care about analyst upgrades or downgrades. They cared about one thing. Is this a quality business that will be worth more in the future than it is today? If yes, buy and hold. If no, move on. That filter alone would improve 90% of investors' returns if they actually applied it. But they won't, because it requires patience that feels indistinguishable from doing nothing. The transition from 100,000 to 1,000,000 isn't a straight line. You'll have years where you gain 30%. You'll have years where you lose 18%. The people who make it through are the ones who understand that the yearly returns don't matter. Only the average return over decades matters. But when you're down 18% in year 7, staring at 115,000 when you should be at 140,000, it takes steel to hold course. Most people can't do it. They sell, lock in the loss, and miss the recovery that would have made them whole plus gains. They turn paper losses into real losses by panicking. There's a moment in the journey from 100,000 to 1,000,000 that nobody talks about, because it sounds ridiculous to people who haven't experienced it. It's the moment your money starts working harder than you do. You wake up one Tuesday, check your balance out of habit, and realize your investments gained 8,000 last month while you were just living your life. That's more than a lot of people make working full-time. And it happened while you slept, while you ate breakfast, while you watched Netflix. That's when the whole game clicks. That's when you understand what Munger meant when he said the first rule of compounding is to never interrupt it unnecessarily. But here's the sick part. Most people never get to experience that moment because they sabotage themselves before reaching it. I watched a teacher named Margaret, 56 years old, spend 14 years building her portfolio from 40,000 to 320,000 through painful discipline. Packed lunches, drove a 15-year-old Honda, skipped vacations, lived in a modest apartment while her friends upgraded houses. Then her daughter needed help with a wedding. Then her son wanted to start a business. Then she herself decided after all that sacrifice, she deserved a kitchen remodel. Within 3 years, she'd pulled out 85,000 for various needs that felt important at the time. She's 64 now, retired with 480,000 instead of the 1,000,000 she'd have if she hadn't interrupted compounding. Those withdrawals didn't just cost her 85,000. They cost her 15 years of growth on that 85,000, which would have been another 350,000. She robbed her future self to please her present self, and now her retirement is tighter than it needed to be. This is the final test. Can you leave the money alone when life gives you excuses to touch it? Because life will give you excuses. Good excuses. Reasonable excuses. Excuses that make perfect sense to everyone except the future version of you who has to live with the consequences. The people who successfully turn 100,000 into 1,000,000 are the ones who understand that every dollar they pull out early doesn't just disappear, it takes its children and grandchildren with it. Compounding is generational. When you interrupt it, you're not just stealing from yourself, you're stealing from your future family. Munger had this thing he'd say, the best thing a human being can do is help another human being know more. So here's what you need to know more about. Taxes are the silent killer of wealth building. You can make brilliant investment decisions and still end up mediocre if you're constantly triggering taxable events. I knew a dentist named William, 51 years old, who made $280,000 a year and invested aggressively. He'd buy stocks, sell them 6 months later when they went up, buy different stocks, repeat. Over 12 years he averaged 11% returns, which should have been fantastic, but after taxes on all those short-term capital gains, his actual after-tax return was closer to 6.5%. Meanwhile, his partner Sarah just bought index funds in tax-advantaged accounts and held them. Her pre-tax return was 9.5%, but her after-tax return was 8.8% because she barely triggered any taxable events. Over 12 years, William turned 145,000 into 315,000. Sarah turned 145,000 into 380,000. Same starting point. Sarah ended with 65,000 more just by being tax efficient. That's the price of unnecessary activity. The path from 100,000 to 1,000,000 is littered with people who were right about their investments but wrong about their behavior. They bought great companies and sold them too early. They had winning strategies and abandoned them during downturns. They understood compounding intellectually but couldn't execute emotionally. The gap between knowing and doing is where most wealth dies. Here's the truth nobody wants to hear. You probably won't get rich from one brilliant investment. You'll get rich from dozens of ordinary investments held long enough to become extraordinary. The S&P 500 has averaged about 10% annually for nearly a century. It's boring, it's unsexy, it crashes sometimes, but it works. And it works precisely because it's diversified enough to survive your mistakes and broad enough to capture growth wherever it happens. The people chasing individual stocks are trying to outsmart a system that doesn't need to be outsmarted. They're playing expert mode when beginner mode wins the game. I watched my neighbor Thomas, 47 years old, turn 95,000 into 1.1 million over 19 years by doing almost nothing. He bought a target date retirement fund, set up automatic contributions of $400 every month, and ignored it. Didn't watch CNBC, didn't read investing blogs, didn't panic in 2008 or 2020, just worked his job as an electrician, lived his life, and let time do its thing. Meanwhile, his coworker Kevin, same age, same salary, tried to beat the market by stock picking and market timing. Started with the same 95,000. 19 years later, Kevin has 520,000. Thomas has double. The difference wasn't intelligence. It was humility. Thomas knew he didn't need to be smart. Kevin thought he did, and that belief cost him 580,000. The secret to turning 100,000 into a million is accepting that there is no secret. It's math plus time plus behavior. The math is compounding. The time is decades. The behavior is not screwing it up. Most people can handle the first two. Almost nobody can handle the third. They get bored, they get greedy, they get scared, they get clever. And every emotion costs them years. Munger said something near the end of his life that stuck with me. The big money is not in the buying and selling, but in the waiting. He lived to 99 years old and spent most of that time waiting. Waiting for businesses to grow. Waiting for value to be recognized. Waiting for compounding to do its work. He didn't get rich because he was smarter than everyone else, though he was brilliant. He got rich because he could sit still longer than everyone else. And sitting still is free. It requires no special skills, no insider information, no advanced degrees. It just requires the willingness to endure boredom while everyone around you is chasing excitement. So here's your roadmap. Take your 100,000. Put it in diversified low-cost index funds. Add to it whenever you can. Reinvest all dividends automatically. Don't check it more than twice a year. Don't sell when it drops. Don't get fancy when it rises. Just leave it alone and let decades pass. In 15 to 20 years, depending on how much you add and what returns you get, you'll cross 1 million. It won't feel magical when it happens. It'll feel inevitable. And that's exactly how wealth is supposed to feel. Not like you won the lottery, but like you played a game where the rules were clear and you simply followed them long enough to win. The people who fail aren't unlucky. They're impatient. And impatience is the most expensive personality trait you can have when building wealth. So be patient. Be boring. Be disciplined. Be the person at the party who has nothing exciting to say about their investments because there's nothing to say. I buy index funds and hold them is the most boring sentence in finance. It's also the most profitable one for ordinary people. If this resonated with you, if you're finally ready to stop chasing shortcuts and start building real wealth, I'd love for you to subscribe to this channel. We're building a community of people who choose discipline over hype, patience over panic, and reality over fantasy. Drop a comment and share your story. Where are you in your journey? What's holding you back? What did you learn from this that you're actually going to apply? Let's learn from each other, support each other, and maybe, just maybe, we can all make it to that million together. Not by being brilliant, but by being stubborn enough to not quit.